Welcome back to the show. Let me ask you something. Have you ever bought an investment simply because everyone else seemed convinced it was the next big thing? If so, you're not alone. Today, we're exploring one of the most expensive psychological traps in investing, the herd mentality that destroys portfolios. Joining me is Dr. Ethan Carter, a behavioral finance expert and investment psychologist who has spent over 2 decades studying why intelligent people often make irrational financial decisions. Dr. Carter, why does herd mentality repeatedly destroy even experienced investors' portfolios? That's a great question because the answer has very little to do with intelligence and almost everything to do with being human. Our brains evolved to survive in groups. Thousands of years ago, following the crowd usually kept you alive. If everyone ran, you ran first and asked questions later. The problem is that that same survival instinct follows us into the stock market, where it often becomes our greatest enemy. Think about the dot-com bubble or the housing boom before the 2008 financial crisis. Millions of smart, educated people believed prices could only go higher because everyone around them believed the same thing. That's social proof at work. When enough people agree on something, our brains mistake popularity for accuracy. Suddenly, buying feels safe simply because everyone else is buying. Now, here's the dangerous part. Herd mentality feeds on emotion, not evidence. When markets rise, people experience the fear of missing out, or FOMO. You begin to imagine the profits everyone else is making while you're sitting on the sidelines. Logic quietly steps aside, and excitement takes over. Then, when markets fall, that same crowd transforms fear into panic. Investors rush for the exits together, locking in losses they could have avoided with patience. Legendary investor Warren Buffett once advised investors to be fearful when others are greedy, and greedy when others are fearful. That sounds simple, but psychologically it's incredibly difficult because going against the crowd feels uncomfortable. Independent thinking often feels lonely before it becomes rewarding. Here's something almost nobody realizes. Successful investing is less about predicting markets and more about managing your own mind. Every investment decision should begin with a few simple questions. Am I buying because I understand this investment or because everyone is talking about it? Has the business changed or has only the excitement changed? Would I still invest if nobody else knew about this opportunity? History shows that market bubbles eventually burst, but disciplined investors who focus on fundamentals, diversify wisely, and stay committed to long-term goals usually come out stronger. The greatest portfolios aren't built by chasing noise. They're built through patience, conviction, and emotional discipline. If there's one lesson I'd leave everyone with, it's this. The crowd may influence today's prices, but independent thinking shapes tomorrow's wealth. That's a powerful reminder. The market doesn't reward those who follow the loudest voices. It rewards those who think clearly when emotions are running high. A huge thank you to Dr. Ethan Carter for sharing these insights. If this conversation changed the way you think about investing psychology, be sure to like the video, subscribe for more episodes on the psychology of investing, and tell us in the comments, what's the biggest investing lesson you've learned from watching the crowd? Until next time, invest with patience, think independently, and keep building wealth one wise decision at a time.